In our first market update of 2024, we're seeing signs that construction costs have stabilised, hinting that the most challenging period may be behind us. However, while supply chains are recovering, uncertainties around future growth are being compounded by concerns around the possibility of supplier insolvencies. Today, I'll run through the macro overview of market conditions. Willem will cover construction output and materials, and Ange will investigate the labour market, energy prices, and the issues of insolvencies. Let's start with the macro overview. After 2 consecutive periods of contraction, the UK has entered recession. However, as price pressures ease and expectations of interest rate cuts mount, the UK's prolonged period of economic stagnation should begin to fade this year. UK inflation remained constant at 4% in January. Yet the overall trajectory is expected to be downward. Economists forecast that headline inflation could return to the Bank of England's 2% target by spring. As for borrowing costs, the central bank has maintained the base interest rate at 5.25% through February, but cuts appear to be on the horizon. The job market is showing positive signs, with unemployment hitting a year low at 3.8%. Nevertheless, the slowing growth in employment and a decrease in job vacancies suggest that the labour market continues to be constrained. Willem will now dive into the market's impact on construction output and materials.
Construction output in 2024 is projected to contract a further 2.1%. However, 2025 is forecasted to grow by 2%, suggesting a U-shaped recovery. If we look at materials, overall, construction materials have started to stabilise, with prices 2.3% lower than they were a year ago. Key materials such as steel, rebar and timber have seen considerable price drops, and this is thanks to lower global demand, reduced energy costs and better availability. Shipping costs have spiked in recent months as diverted vessels between Asia and Europe take slower routes due to the conflict in the Red Sea. This could have a spillover effect on prices of imported materials. So far, this diversion is having minimal impact on the construction sector.
Firstly, looking at the labour market. While construction job vacancies still surpass the 10-year average, we did see them fall last year. The key input cost driver in 2023 was construction wage growth, which appears to have passed its short-term peak and is beginning to normalise. Moving on to energy. The Red Sea conflict could leave energy markets exposed. Around 12% of the world's oil and 8% of LNG trade is transported through the conflicted region. But without significant escalation, we do expect the impact on energy prices to be contained. Unfortunately, supply chain insolvencies remain a potential threat this year. In 2023, we saw a 9.6% increase in construction company closures. However, by carefully monitoring and navigating insolvency risks, we can preserve stability during these uncertain times. More on this can be found in our comprehensive market update report.
To summarise, this quarter's key takeaways are: input cost pressures are easing, and despite the Red Sea's unpredictability, its impact on the construction sector remains minimal so far. Supply chains are regaining their footing. However, we must keep a close eye on insolvency risks. And finally, anticipated falls in borrowing costs could strengthen project feasibility. Remember, the market is constantly evolving, so speak to your G&T advisor in relation to your project, and stay tuned for our future updates, where we'll continue to keep you informed about the latest forecasts.
To find out the details behind the headlines, visit G&T's Market Intelligence microsite and get in touch with our experts today.